Okay, so if you've been online or, watching the news lately, you've probably seen them, those headlines.
Oh, yeah. Market crash 2025. Screaming about a potential collapse.
Exactly. And it's the kind of stuff that, well, it can make you feel pretty uneasy,
Right.
especially with your own money involved.
Absolutely. That kind of noise, it's distracting, creates real anxiety for investors, no doubt.
So today, we're going to dive deep into that specific fear. We're working from an article we found on thegreateconomy.com.
Right. The title is Market Crash 2025 Analysis and Strategies.
And our mission here for this deep dive is to really unpack the fears this article talks about. Look at the history it provides, explore the strategies it suggests.
And really importantly, we're sticking just to what this specific source is telling us.
Good point. So the article starts by defining what a market crash actually is, according to them.
Yeah, basically, it's a sudden, pretty significant drop in stock prices, often driven by, well, panic selling.
And triggered by things like economic downturns or maybe unexpected policy changes.
Exactly. Economic triggers, that kind of thing.
And look, volatility right now, May 2025. It's been hard to ignore. The source actually points to recent movements.
It does, like that S&P 500 drop early April after those tariff announcements came out, several percentage points.
And didn't it mention the NASDAQ too? Something about bear market territory.
Yeah, it dipped into bear market territory around then as well, which, for a lot of people, that signals serious trouble.
Which definitely sounds scary. But the article also hints early on that markets, well, they're emotional.
Right, roller coasters. And short-term drops, even pretty big ones, don't always mean a total collapse is coming.
It suggests history gives us a different lens, maybe, hinting that recoveries are like a normal part of the pattern.
That sets us up perfectly. Let's get into why this article thinks fears are so high right now in 2025.
Okay, let's unpack these layers. The question is the market crashing. Isn't exactly new, is it?
Not at all. But this source points to some specific factors making things feel more intense this year.
All right. What's the first big one it zeroes in on?
Okay, first up, high market valuations.
High valuations. What kind of numbers does the article use to back that up?
Well, it mentions the S&P 500's price-to-earnings ratio, PE ratio, hovering around 30.
30. And it calls that out as being...
Near an all-time high, yeah.
Yeah.
Historically quite elevated.
And it also brings up the Buffett indicator.
It does. That's the total U.S. stock market cap compared to GDP. And it says that's above 200% right now.
Wow. And the source reminds us, didn't Buffett call that level something like playing with fire way back?
That's the quote, yeah, from 2001. So what these high valuations suggest, according to the article,
is that stocks might be kind of overpriced, vulnerable.
Potentially, yes. Overpriced relative to earnings or the economy. More vulnerable to a shock or a downturn.
Does it give any examples?
It points to some sharp declines we saw in big tech names like NVIDIA earlier in 2025, raising those broader concerns about, is this sustainable?
Okay, so high prices, potential overvaluation. That's concern number one. What's next on the list from the article?
Factor number 2, tariff and trade war tensions.
Ah, yes. The article specifically mentions President Trump's April 2025 tariff announcements.
Right, including that proposed 10% minimum tariff on, well, most imports.
And the market didn't like that much, did it? Based on the source's reporting.
Not at all. The reaction was immediate and pretty sharp. S&P 500, NASDAQ, Dow.
All down.
All lost between like 3.5% and 5% in just one day. Right after the news broke.
And it wasn't just U.S. markets, right?
No, international indices too. FTSE 100, Nikkei 225. They saw significant drops as well.
And the article's analysis suggests these tariffs could have knock-on effects.
Yeah, potential downstream impacts, like pushing up inflation because imports get more expensive.
Which could squeeze consumer
Spending, exactly. And potentially nudge the U.S. economy closer towards a recession. That's the worry highlighted in the source.
Okay, so valuations, tariffs. What's the third factor?
The third one is rising inflation and interest rates.
Inflation. Seems like we've been hearing about stubborn inflation for a while now.
And it's still persistent, according to this article. And the Fed, well, they haven't seemed eager to cut rates aggressively.
Does the source mention anything specific about rates or indicators?
It does highlight the yield curve, specifically the 10-year versus the 3-month Treasury yield. As of March 2025,
What about it?
it was nearly inverted, close to flipping.
And why does the source flag that? Why is an inverted yield curve significant here?
Because historically, the article identifies it as a pretty reliable recession signal.
Okay.
An inverted curve can mean bond investors are expecting rates to fall, which usually happens when they expect, slower growth or a recession ahead.
And high rates themselves.
Yeah.
How do they impact stocks, according to the article?
Well, high rates generally make borrowing more expensive for companies, for consumers.
Which just hits profits.
It can squeeze corporate profits, yeah.
Yeah.
Makes their existing earnings seem less valuable, potentially hitting stock valuations.
And the article even mentions some analysts predict more hikes.
Yeah, that the Fed might actually raise rates again in 2025, which, in their view, makes a crash more likely. Quite a prediction.
Wow, okay. A rate hike prediction. That's
Ah.
bold. All right, fourth factor the source brings up, consumer debt and potential economic slowdown. This feels closer to home for a lot of people.
It really does. The article gets specific here. Credit card debt, auto loans, mortgages, all hitting record highs.
Any specific stats jump out?
Yeah, a pretty stark one. 20% of Americans, it says, are struggling just to pay their credit card balances. 1 in 5.
That's significant. So how does that debt load ripple outwards, according to the article?
The main concern is consumer spending. It's such a huge driver of the economy, right?
Right.
If households are swamped by debt payments, that spending could really falter, slow down significantly.
And it links this to GDP forecasts.
It does. It points to a forecasted 2.2% GDP contraction for the first quarter of 2025.
A contraction. Negative growth.
Yes. And the article notes that level mirrors what was seen right before the 2008 crisis and the 2020 recession. Those comparisons really make you pause.
Yeah, they do. Okay, finally, the fifth piece this article mentions is geopolitical and policy uncertainty.
Right. Kind of a catch-all, but important. It lists ongoing conflicts. Middle East, Europe.
And uncertainty around policies here at home.
Yeah, uncertainty around Trump's policies is mentioned as contributing to global instability, which can definitely weigh on market sentiment.
The article even notes what people are saying online, like on X.
It does. It mentions some users predicting a global bust. Their words tied to all this debt and leverage, just highlighting the level of fear out there.
But it's careful to frame that as reflecting fear, not necessarily endorsing the prediction itself.
Exactly. The source uses it to show the mood, the anxiety in the market. So you put those 5 together, valuations, tariffs, rates, debt, uncertainty, and you can see why the article says concerns are running high.
It's a heavy list. But importantly, the article doesn't just leave it there, right? It offers a counterpoint.
It does. It makes sure to mention that not everyone sees doom and gloom. Some experts cited are still optimistic.
Like who?
Goldman Sachs, for instance. The article mentions their projection for the S&P 500 to actually rise 5 to 7% in 2025.
Based on what?
Driven by expected corporate earnings growth, around 10%, suggesting there's an underlying resilience the market might be missing.
That's definitely an important perspective to balance things out. Okay, so we have the current fears laid out. Now, what about history? What does the article say history tells us about these crashes?
History, the article argues, gives us vital perspective. Perspective we often lose when we're in the fearful moment.
How often do these big crashes happen, according to the source?
It notes that over the last 150 years, the S&P 500 has faced about 10 major crashes, and it defines that as a drop of 20% or more.
So roughly, one a decade.
Roughly, yeah. It's not an everyday event, but it's a recurring one.
And the article walks through some key examples from the past.
It does. Goes way back to 1929, the start of the Great Depression. Huge crash, 79% decline. Took 4 years just to get back to even.
Driven by what, mainly?
Overconfidence, crazy valuations back then, just unsustainable.
Then it jumps to 1987, Black Monday.
Yep, Black Monday, the Dow dropped over 22% in a single day. Wild.
Wow. And the cause there?
More related to program trading getting out of control plus overvaluation again, but the recovery was much faster.
How fast?
Just 2 years, the article says. So a much quicker bounce back than 1929 shows how different these events can be.
Then there's 2008, the financial crisis. A lot of us remember that one.
Oh yeah, the S&P 500 fell 57% peak to trough, triggered by the subprime mortgage mess, bank failures.
And the recovery time there.
Took until 2012 for the market to fully recover those losses.
And the most recent example the article uses, the COVID crash in 2020.
Right, that was incredibly sharp and fast, down 34%. But the recovery was also incredibly fast.
Yeah, fast.
Just 4 months. Unprecedented speed, really. Though the article notes massive government stimulus played a huge role there.
So looking at all these historical examples, what's the big takeaway the source emphasizes?
The main point is, recovery is the norm. That's the crucial lesson from history, according to this article.
Even after really severe crashes.
Even then, they didn't spell permanent doom for long-term investors who held on. The source even gives an average duration for bear markets.
Oh, yeah. What is it?
286 days. So just under 10 months on average. And crucially, recoveries usually lead to new all-time highs eventually.
That historical pattern that markets fall, but they get back up again, feels like a core message here to counter today's fears.
Absolutely. It's vital context for understanding the current volatility based on this source.
Okay, so history provides perspective, but what about the experts looking forward right now? The article apparently gives a snapshot, and it sounds like opinions are all over the place.
They really are. The source presents views from, let's say, different camps. You've got the bearish views.
Who's in that camp, according to the article?
It mentions folks like Robert Kiyosaki. He's apparently predicting a crash even bigger than 1929, calls it an everything bubble.
Strong words? Anyone else?
Jeremy Grantham is also cited, warning of a potential cataclysmic decline. He ties it to overvaluation and, broader global challenges.
Okay. Any more specific predictions?
David Kotok from Cumberland Advisors. The article mentions he sees the S&P 500 potentially falling to 4,000. That'd be like an 8% drop, maybe more, from when the article was published.
And John Hussman?
His recession gauge is highlighted, apparently signaled a downturn risk back in April 2025, linked to tariffs, economic weakness, the factors we discuss.
So that's a pretty grim picture from the bears. What about the other side? The bullish views?
Yep, there's optimism, too. We touched on Goldman Sachs earlier. The article cites their forecast, S&P 500 returning 7 to 8% in 2025.
Driven by?
AI-driven earnings growth, mainly. That's their thesis.
What about Warren Buffett? Does the article put him in either camp?
It mentions him, but notes he famously avoids making crash predictions. His approach is more about preparation, not timing.
But it does mention his cash pile.
Yeah, his huge $325 billion cash stockpile is noted. Could suggest caution, maybe. But the article is careful not to say he's actively calling for a crash.
Got it. So, bears, bulls, are there any more neutral views presented?
There are. Like David Keller from Sierra Alpha Research, he's cited seeing potential support for the S&P 500 around 4,850.
But with a warning.
Yeah, but warns that bearish trends could stick around unless the index gets back above its 200-day moving average. That's a key technical level for trend watchers.
And the Motley Fool.
They're mentioned too, mainly advising against selling just because you fear a crash. They argue timing the market is super difficult, and you often miss the big gains on the way back up.
Okay, so summing up these expert takes, it's a real mixed bag. Pessimism, optimism, caution. What's the article's final word on trying to predict the timing?
It's pretty blunt, actually. It says plainly, no one can predict the exact timing, period.
And it uses that Buffett quote.
It does. Warren Buffett. Short-term market forecasts are poison. Hard to argue with that wisdom.
Feels like a really key takeaway from this whole section. So if you can't predict it, what can you do? The article shifts focus here, right, to preparation.
Exactly. Whether a crash comes or not, the source says preparation is key. It lays out several practical strategies.
What's the first big one?
Number 1, diversify your portfolio.
Classic advice. How does the source explain its benefit in this context?
It's about not putting all your eggs in one basket, basically. Spreading risk.
Across different what? Asset classes?
Yes. Stocks, bonds, also across different sectors within stocks. And different geographies too, U.S., international. Reduces the blow if one area gets hit hard.
Does it suggest specific assets for diversification?
It mentions considering bonds, like corporate bonds, maybe for some stability and income if stocks are falling.
What about gold?
Gold gets a mention too, as a traditional hedge against volatility. It even points to things like the GDX ETF, which tracks gold miners, as one way to get exposure.
And defensive stocks.
Right. Sectors like consumer staples, think food, household goods, and utilities. The article notes these held up better in the early 2025 downturn.
Why is that?
Because demand for what they sell is less tied to the economy's ups and downs. People still need electricity and toothpaste, right?
Makes sense. Okay, diversification is strategy 1. What's number 2?
Focus on long-term investing.
This ties back to the history lesson, doesn't it?
Directly.
Yeah.
The source just hammers home that historical evidence. Staying invested through the downturns has historically paid off.
It uses the 2008 example again.
Yeah, points out that investors who panicked and sold near the bottom missed out on that powerful recovery that followed, a painful mistake.
And it mentions a technique. Dollar cost averaging.
Right. Investing a fixed amount regularly, say every month, you automatically buy more shares when prices are low and fewer when they're high. Takes emotion out of it.
And it frames downturns as.
Potential opportunities, actually, for long-term investors to buy good companies when they're on sale, emphasizes focusing on strong fundamentals.
Okay, long-term focus. Strategy 3 sounds related. Avoid market timing.
Yes, absolutely critical according to this source. Trying to guess the top, sell everything, then guess the bottom to buy back in.
Sounds stressful.
It is. And the article says it's notoriously difficult and often backfires. People end up selling low and buying high, or just missing the recovery altogether.
Does it have any data on staying invested?
It cites a Wealthfront study from 2023. Said staying invested for 15 years or more basically reduced the chance of losing money to almost zero, like 0.3%.
Wow, that's compelling for the long haul. And there's a Peter Lynch quote in there, too.
A classic one. Far more money has been lost by investors trying to anticipate corrections than in corrections themselves.
Powerful quote. Okay, so avoid timing. Strategy 4 is seek high-quality stocks.
Right. If you are investing, focus on quality.
What does the article define as high quality in this context?
Companies with strong fundamentals. Things like low debt levels, consistent earnings growth over time, and some kind of competitive advantage, a moat, you know.
Any specific areas mentioned?
It brings up AI and tech again, suggests companies heavily involved in AI infrastructure or using AI effectively, it names Microsoft and Amazon specifically, could be good long-term bets due to potential productivity gains.
It also mentions value stocks. How does it describe those?
It uses the phrase high beta, low risk, which honestly sounds a little contradictory. Beta usually measures volatility risk.
Yeah.
Perhaps what the source means is stocks that are currently undervalued, so maybe more volatile in the short term, hence high beta relative to their depressed price, but have solid businesses, making their fundamental risk lower.
Okay, so maybe focusing on fundamentally sound companies that the market has overlooked.
That seems like the core idea, yeah. Finding quality that's maybe temporarily out of favor. It also suggests value stocks may outperform during corrections.
Got it. Good clarification on that wording. And the final strategy the article suggests.
Consult a financial advisor.
Why is that important, according to the source?
Because advice should be personal. A fiduciary advisor, one obligated to act in your best interest, can help you build a plan tailored to your specific risk tolerance, your goals, your timeline, especially helpful when things feel uncertain.
So those are strategies for protection. But the article also flips it around, right?
Right.
Talks about buying opportunities amid volatility.
It does. The flip side of a downturn is that things get cheaper. For investors with cash ready or those looking to rebalance, downturns can present chances.
What kinds of areas does the source suggest looking at for potential buys during weakness?
It revisits some themes, consumer staples, again, names like P&G, Walmart, resilient businesses.
Utilities, too.
Utilities like NextEra Energy, yeah. Mentioned for stability and dividends. It hits AI and tech again, Amazon, Microsoft reiterating that AI infrastructure view for the next 5 years.
Any other sectors?
Energy and financials get a mention. The article suggests they could potentially get a boost from deregulation under the current administration.
But with a caution, right? Don't just buy anything that's down.
Absolutely. Crucially, the source emphasizes, do your homework first. Check the fundamentals before you buy. Look at debt levels, earnings growth prospects. Don't just catch a falling knife.
Right. Makes sense. Okay, looking beyond the immediate crash fears, the article briefly touches on a stock market prediction for the next 5 years, acknowledging it's tough, of course.
Very tough. But it identifies a few broad trends it thinks could shape returns over that time frame.
Like what?
AI growth is number one again. The source seems pretty convinced that continued investment and adoption here will drive gains, especially in tech. It names Meta and Google as potential leaders, too.
What else?
Economic cycles. Just acknowledging they happen. If tariffs or something do cause a recession, the source suggests recovery might take, say, 2 to 3 years. But again, reinforces that markets do historically rebound.
And global factors.
Yeah. Things like trade policies, geopolitical stuff, they'll continue to matter, but the article suggests diversification is the way to help mitigate those specific risks.
And ultimately, for that 5-year view, the source comes back to
That Buffett wisdom again. Time in the market beats timing the market.
So the focus for the next 5 years, according to this article, should really be on quality investments and just having that long-term horizon.
That's the strong message, yes. Discipline, quality, patience. That seems to be the core advice for navigating the years ahead, based on this source.
Okay, so let's wrap up this deep dive. We came back to that big question. Will the market crash in 2025?
And the clearest answer from this specific article on thegreateconomy.com is nobody knows for sure. No crystal ball.
It really presented this balancing act, didn't it? You have these serious red flags. The article laid out those high valuations, the tariff impacts, inflation, debt, uncertainty.
Plenty of reasons for the concern and fear that's out there right now. The article validates those worries.
But then it counters with the potential resilience of the economy, maybe driven by things like AI growth.
And maybe most powerfully, that historical perspective, that clear pattern the source highlighted. Markets recover, even from nasty falls.
So the key advice, the actionable takeaway from this source, really boils down to don't panic. Prepare instead.
Right. Diversify, focus on your long-term goals, avoid trying to time the swings.
And maybe even look for opportunities if the market does give you lower prices on quality companies.
A disciplined approach, focusing on what you can control, your strategy, your emotions, rather than obsessing over what you can't, the market's next move. That seems to be the essence of the article's advice.
Which leaves us, and you listening, with maybe one final thought to chew on, building directly on what this source laid out. Given that consistent historical pattern of eventual market recovery the article detailed, is it possible that the psychological toll, the stress, the worry, the potential bad decisions driven by fear of a crash could actually be more harmful to your long-term financial well-being than the temporary impact of a crash itself might be?